I'm Chris Preston.
Hi, Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network, which has been delivering investment advice for the past 55 years to individual investors. Um, Brad, lots going on in the market right now. I know you are probably deep in your spring training hot dog phase, or has that started yet? I don't even know.
Mostly done with spring
Oh,
training hot
done.
dog phase. Yeah,
Hot
I'm
dog and
running
tacos, right?
mostly tacos and nachos with hot dogs as an afterthought. I'm running the stand again on the 22nd of March, but that's my last day. So I put 3 days in already. I got another or 3 weekends in already. I've got a fourth one coming up, and then Disney. So
How many are you slinging per day?
boxes of nachos like 200, box of tacos like another 150, and then like 60 dogs plus beers and sodas.
Are
It's a good
tacos more
fundraiser.
popular because you're in the, American
Nacho,
Southwest? Nachos.
nachos dominate. Nachos are the go-to for everybody there. They're pretty good too, all things considered. Like for ballpark food.
Yeah, that sounds good. Yeah, I don't. Yeah, I've seen nachos at games out this way, Fenway or the local Vermont Lake Monsters. But I don't think they have tacos here. It seems more specific to where you live.
Yeah, definitely. Like we sell like a bunch of margaritas. So we
Oh
don't
wow.
sell like the ballpark nachos where it's just orange cheese and chips. Like we have the like with meat and pickled onion, like all kinds of stuff on it.
Yeah,
And then we
that
sell
sounds
a ton
better.
of
Much better.
margs. So it's more like a little Mexican restaurant. It's I don't know. It's
Sounds like a
fun, I
party.
guess.
Yeah, that
Yeah,
sounds.
if you're not working it, it's a
Yeah.
blast, I'm sure. Enjoy a game out in the sunshine, weather's nice, have a margarita, a couple of beers, eat some tacos or nachos. It's great. But if you're
Yeah.
working, you're just working in a commercial kitchen.
Yeah. Warmth and sunshine, that part sounds better than anything. We're still we've got the sunshine part here now in Vermont, but we still are struggling with the warming up part. Anyway, I digress. Let's get to, like I said, busy day. Let's get to everything that's on tap.
Yeah. So obviously talking about tariffs, market hates them. We will talk about how much further stocks could fall. It has been a tough couple of weeks, and I don't know, looks like it could keep going. We will get further into that. And then we're going to talk a little bit about outperformance of value stocks, European stocks, most notably. And then after that, we will do our jump ball segment and we'll sort of bounce around market, monoculture, et cetera, et cetera.
But before that, as always, we have our defend the take. And today, Brad, you're up. Your take, for which you have 90 seconds to defend, is that Trump's crypto strategic reserves won't help Bitcoin now. Again, you have 90 seconds. Go.
So it got a lot of attention. Obviously Trump campaigned on being like a crypto president and making like the US the capital of crypto, or however he framed it. And then through executive orders, he sort of guided agencies to start considering cryptocurrency reserves. Um, and then the other day, we got an executive order basically putting those into motion. Bitcoin had obviously is backed off of its all-time highs quite a bit. I think it's trading around 90,000 now from as high as like 106. But we are getting more clarity on what exactly this crypto reserve means, because the speculation is that the US government is going to go out and start buying Bitcoin just like hand over fist and just like, pushing billions of dollars into it. There was a bill that was floated last year that would have had the US government buying 1 million Bitcoin, which would have given them about a 4% stake of the total float of Bitcoin out there, maybe closer to 5%, sort of depending on how many have been mined. But the most recent news is that the crypto reserve, for all of its press and attention, is just going to be the federal government keeping the crypto that they've already seized. Well, the Bitcoin specifically that they've already seized as part of like criminal seizures. Even if they were going out and buying 1 million Bitcoin over the next 5 years, the thing that is killing it is the markets. It is a risk-on asset. It is highly correlated with speculation. You can see it in how it moves relative to the S&P 500. The
Time.
things that could potentially drive it higher are gone.
Yeah, I think that's true. I mean, I think just the main thing is we've talked about Bitcoin as a bull market stock now, sorry, bull market play. Bull market isn't necessarily over. We'll get into that. I don't think it's over, but it is undeniably taking a big hit right now. And, you could buy on the pullback. But as I said a few weeks ago, when Bitcoin, granted, this was when Bitcoin was at new highs. Did it get to 100,000? Is that
It
right?
was
At 90.
106, 107 at its heights.
Yeah, it was just maybe just shy of that. I wouldn't have bought it at those levels. I think you said you might have. At these levels on the pullback, I still think the upside is sort of limited. And yeah, I wouldn't buy just on the premise that, now just on the premise that, is going to unleash these strategic reserves.
No, I definitely would not be buying here. And, I was bullish on it in the 90s. I was still bullish on it when the bull market was still in full effect. Conditions have materially changed since then, and we'll get further into that. But it's
Yep.
it's a it's a risk extension. It's just a way of it's just
Right.
another play as part of like an exuberant bull market. And if we don't have an exuberant bull market, it ceases to be a good play. Um,
Right.
I do, I do think that it maybe had more upside, especially at the end of the year. It looked like it had more room to run potentially, but knees got taken out from under it. There was a Chinese stimulus announcement last week that lifted it a little bit, and it's sort of backed off of those levels again. So it's been sort of trying to fight higher, but it can't fight the trend, and that the trend is lower right now.
Yeah, so let's get to that trend. Market is the Nasdaq. If you go by the Nasdaq, we are in a correction right now. It's
Yeah.
surpassed the 10%, down more than 10% level. I think it's just shy of 11% as of now. It's, when we recorded last Friday, I think it's the second we stopped recording, stocks suddenly were up, what, like 1.5% by the end of the day after being down for most of the morning. So, this could change. But um, as of this recording, Nasdaq down close to 11% from its highs of February 19th, all-time highs. Oh, wait, sorry. It was February 19th slash, I think it was maybe a little higher in mid-December. The Nasdaq was at least. But bottom line, from its highs, roughly 11%. So that's a correction. S&P um, down since the 19th, about 7% from its highs. So 2.5 week, pretty extreme pullback right now. And a lot of it is definitely has to do with tariffs. Trump went ahead after a delay, went ahead and followed through with the 25% tariff on Canada and initially Mexico, but then said that certain imports were exempt from Mexico, and he's delaying that for another month. They thought the market might bounce back after that, but it just fell further, maybe due to just all the back and forth and uncertainty and volatility. China's the tariffs there doubled from 10 to 20%, and Canada's reciprocated with its own 25% tariffs, and China's reciprocating on their end. Uh, Lots of tariffs in the last few weeks, and none of it has been good for the market. As let's do this without being, trying not to be political. Trump is hurting the market right now.
Yeah. Yeah,
As the
aggressively.
president, your role is to kind of do no harm to both economy and market, or by extension market. And he's doing harm with the tariffs right now. Part of that is the calculations that tariffs on Mexico and Canada alone will add 0.2% to GDP. Sorry, subtract 0.2% from GDP growth. And yeah, market making it abundantly clear over a month ago when he first was going to roll out the tariffs on Mexico and Canada that it hated it, and the second he pulled them back, there was sort of a short stint of exuberance, which led to the record highs in mid-February. The fact that he didn't this time, or mostly hasn't, and hasn't at all with Canada. We're seeing the impacts of that. What's your take?
All right. Well, all right. Trump is a political bomb thrower, right? Whether it's as a negotiating tactic or whatever, if you come out and say, okay, well, I'm going to implement 25% tariffs across the board, right? Like that's your bomb thrown. And then you say, oh no, I'm going to pull them back or I'm going to delay them so we can negotiate. The problem is that assumes a level of conduct from everybody in the world that matches your level of conduct, which is being unpredictable. Canada is under no obligation to say, okay, well, ooh, Trump pulled those tariffs that he threatened back because he's exercising the art of the deal. So we're going to do the same thing.
Hmm.
No, they're pragmatists that say, okay, well, if they're going to just implement these tariffs without consideration to the harms that it'll do economically, and this is going to be a persistent threat, we'll just leave our tariffs in place. Not only that, we're going to start tolling trucks that run from the US to Alaska that pass through Canada, right? So we're going to implement added fees there. It's the risk of somebody that is not serious politically interacting with a global politic that is and remains more serious. And the problem, I think, largely, and we'll talk about European stocks, but the problem is largely what we don't make policy based on a month at a time or 6 months at a time or a year at a time. We make policy based on longer term projections. And what we are showing right now is that we are not a serious counterparty to negotiations. Um, Europe, right? Like you can rely on a treaty only to the extent that you can rely on the parties that are governed by that treaty. And we're showing that we're neither a serious country nor a reliable trade partner or potentially defense partner, sort of depending on the impulses of the people that are involved and depending on the day of the week, seemingly. But even beyond that, how do you estimate what, let's say, Alcoa is going to make
Hmm.
if their costs for inputs coming from Canada on Tuesday are 25% higher than they are on Thursday, right?
Right.
It's easy to forget when we look at things like momentum and just like money flow in the stock market. There is a subset of the investing public and institutional investors, notably, that like to say, okay, well, the company's earnings growth rate is 15%. Based on that earnings growth rate, we will project that 5 years in the future, this company will be trading at a price to earnings of 16 or whatever, like whatever your criteria is, whatever your number is. If you can't estimate the earnings growth rate for the next 6 months because of phantom tariffs that may or may not apply, how are you going to try and make any kind of projections going out 5 years? You
Yeah.
can't. You
Yeah.
can't. So you undercut anybody that's taking a serious look at the stock market when you say, well, hey, these variable costs could rise 25%, they could fall 25%, hey, 50%. We don't know. Maybe it goes up 50% because Canada throws some reciprocal tariffs on us, so we add additional tariffs after the fact. We have talked a lot about how much the market hates uncertainty. I mean, I think that was when we were talking about like the Fed last year, that was like a recurring theme was market hates uncertainty. And right
Hmm.
now we are in a deluge of uncertainty. And if you can't
Yeah.
make predictions or if you can't make best estimates, you can't project forward. And if you can't project forward, you can't fairly value stuff. And if you can't fairly value something, why buy it?
And
Right?
that's why I think that, I think he thought that, he saw the market was reacting to the imposition of the 25% tariffs on Canada, Mexico, and then he came out with the delay on Mexico and what was it, the three big autos exempt
Yeah.
from that, and yet stocks continued to fall even further. And I think goes to what you're speaking to is like, so it's even more unpredictability, more uncertainty, like just as the market was wrapping its head around that, then it changes again. It changes every day. And there's too much volatility, too much uncertainty right now. And yeah, everything I think you said is spot on. I think this is mostly about Mexico and Canada. China, he imposed tariffs, and China imposed tariffs on us during his first term. and it's doing the same now, and it didn't really affect the market. Um, and similarly, you know, the market reacted positively when they delayed tariffs on Mexico and Canada a month ago, but China still went into, they've since been doubled, but went into effect. I think this is mostly about Mexico and Canada, um, two neighboring trading partners. Um,
Yeah. So
yeah,
before,
I mean, and all that exuberance post-election is I mean, the stocks are down since this election. All the positive vibes after he was elected, the promise of strong returns his first time around, have evaporated for now.
yeah. And I want to add two things. One, like China trade tariffs, right? So like there's a $800 de minimis exemption from like import taxes. So if you're Temu or whatever like cheap Chinese seller or any of the third party sellers using those services, if you implement a tariff or taxes on those de minimis exemptions, okay, big deal. We can't buy cheap plastic garbage from China, right? Like
Hmm.
that doesn't. Okay, so you can't get like a spatula that you were looking at. Like it doesn't materially impact our ability to function as an economy. When you start hitting food imports, raw material imports, you undercut the chunks of industry that we still have, which leads me to, I guess, what will probably be my final point. We are a spending economy. We spend on services. Our economic strength does not come from our ability to produce goods and services that the world wants. It predominantly comes from our ability to spend money on other goods and services and internally. We're 70% service economy. Consumer confidence and business confidence, so business starts and consumer spending are huge, huge drivers for the strength of our economy. And if everybody turtles up or runs to their bunker and decides that now's not a great time to spend on stuff, now's not a great time to borrow money, it takes the legs out from under our economy. Um, you can't be, well, you can be, but you shouldn't be disruptive to employment strength, business predictability. Like that kind of stuff has an outsized impact when it's if we're making widgets that go in every single car that's sold across the globe, it doesn't really matter how confident we feel because we can continue producing and selling widgets. If we're making money because people feel comfortable spending money and you take that away, then that puts us in a world of hurt.
Yeah. Okay, let's move on to number two. Pretty connected. How far could stocks drop, and what could spark a turnaround? Like I mentioned at the top, S&P is down now about 7% in the last 2.5 weeks, 7% from highs, all-time highs. And the Nasdaq is down about 11%. That's a big drop in just 2.5 weeks. But play sort of, maybe devil's advocate, or not even devil's advocate, soothsayer. Maybe here, we did have a similar drop last July and August. The Nasdaq was down 12% in just under a month from top to bottom. It started in July 10th, and the bottom came August 5th, 6th. And yeah, 12% pullback. S&P was a little over 8%. So this isn't even anything new in the last year. Doesn't mean that the bull market is about to evaporate. But sentiment, yeah, you could go two ways with this. Sentiment, is definitely lower now than then. But volatility is actually also lower if you measure just by the VIX. The VIX spiked, if you measure, spiked to a record or near record last August. This was on the jobs report and the Japanese carry trade news. It spiked to, well, let me get it right here. Um, at least on a closing basis, 38. I think it was higher than that. I think get to like 60 or something intraday. Anyway, but that was right at the bottom, August 5th. And right now it's at 25. Even in mid-December. late December, VIX was a little bit higher at 27. So looking for silver lining, there's a couple things. This has happened before in the last really 9 months. And also, the volatility is actually not as high as it was a couple different times in the last 9 months. Um, and I think what could spark a turnaround? I think Trump's interest in the market, he said himself that a president who, if the Dow falls 1,000 points in 2 days, president should resign. Well, that means he should have resigned twice in the last 2.5 weeks. But I think his interest in the market and seeing it as sort of a report card for the president, I think he'll do what's necessary to turn it around, or at least we'll try to, pretty soon here. Now that we've officially entered correction territory with the Nasdaq, I think that could be enough to spook him with all the tariff stuff. What say you?
Well, I will note yesterday, he did say that he was not looking at the stock market, and then he blamed globalists for stocks selling off. So,
I don't even know what that means.
really,
Yeah.
oh, it's not his fault that the market's selling off. It has nothing to do with
Well,
him.
yeah, yeah, I figured that part.
So,
Yeah.
so that was his note yesterday. So I don't know, like the variability in the things he says makes it tough to like take him at face value for a lot of these things.
But
So
we
maybe,
know, aside from his words, we know he loves the stock market, and we know that
yeah,
he does see it as a report card. I think one of his arguments was how well the stock market did during his first term, which is true.
yeah. And then complaining about it yesterday, right? Like being contrary to that, but it's like, okay, well, which statement do we want to take it at
Yeah.
face value? Um, so we had been up until like an hour ago, really just sitting on top like the 200-day moving average with the S&P. If we get to correction territory, that puts us like around 5,500, 5,450. That's sort of a reasonable level for support to come in potentially. Um, I, assuming nothing comes in that's going to serve as more of a backstop, I'm eyeballing like the 5,200 level as probably being more reasonable support
Hmm.
that keeps us in correction territory, but it's beyond what, or it's not as far as what would become a bear market.
Yeah.
Realistically, if we do end up getting into bear market territory, well, 4,600 is probably closer to where I am looking, just based on technicals. And as far as what could reverse it,
Do you think this becomes a bear market?
uh, it depends on Doge. If we get mass layoffs, which like the the
That
thing
was
with
part of
all,
that showed up at least slightly in the jobs report this morning. That was another news item we didn't even mention. Jobs report came in a little lighter than expected, not as bad as the previous month, but still, not enough to persuade the market. Anyway, go ahead.
yeah, but okay, so we also have next 10 days from now or so, we've got a possibility of a federal shutdown. Um, I guess it depends on how far the federal government's going to push it. If we if if the things that people are concerned about come to fruition, so let's say we get mass federal layoffs, let's say we get a government shutdown, let's say we get Medicaid or Medicare cuts, let's say Social Security gets into risk, like yeah, we get into a bear market. That's recessionary, that's maybe stagflationary if growth really craters and the tariffs take effect and costs all skyrocket.
Yeah.
Right? Like that's the nightmare scenario. That's the thing that the Fed has spent the last 4 years trying to guard against.
Right.
That's the nightmare scenario. The thing that stops it would be some sort of like major quote unquote victory where Trump comes out and says, "Okay, well, we're not going to do any of that at all." The thing that has me doubting that is the tariff threats over Canada and the US. It's not like these are trade deals that were negotiated under Biden or trade deals that were negotiated under Obama. These are trade deals that were negotiated under Trump in his first term, right?
Yeah.
I don't know, like threats are all well and good until you either have to blank or get off the pot. And my, I think everybody's fear is that it just keeps, is that what seems like an empty threat is not. So we
Yeah.
get the tariffs, we get the mass layoffs, we get the job cuts. And at that point, yeah, I'm looking for us to reverse all of 2024's gains and then some.
Yeah. Um, yeah, I think the next couple weeks are really going to tell us a lot.
Yeah.
Um, if there's a we find bottom, or at least, seems like if things flatten out a little bit, selling slows, number of new 52-week lows on the New York Stock Exchange, which is a good measure, starts declining in the next week to 10 days. I think that'll be a positive sign. That was a sign that the usual thing that happens with investor sentiment plummeting um, happens again, where people like, stocks go the other way. It's a sort of contrarian indicator, as we talked about with Nancy Zambell on here a couple of weeks ago. Um, so yeah, next week or two are going to be really telling. One thing I'll note: Cliff Droke, who's really good on all things market, is chief analyst of our Cabot turnaround letter, wrote this morning. He made a good point that you don't know something's a bear market until just about the time that it's going to about to turn around. You know, Bear markets usually don't. So the definition is 20% or more from the highs, drop off from the highs in the S&P. Um, Usually they don't go beyond, usually doesn't go beyond 30%. So you 20 to 30% range generally is how had the depth of the pullback. And that was definitely the case in 2022. The worst the market felt was October 2022, and that's when officially the new bull market started. This new bull market started. So he said, he looks at if all the major indexes, he threw in small caps, mid caps as well, are trading below their 200-day moving average, that he considers it a bear market. And right now, the Nasdaq has dipped below it. S&P is not. Um,
S&P has as of this recording. So
as
it
of
is
this recording.
so
Well,
it's trade
I think closing basis is probably what he meant. So we'll
sure.
see. Um, but then I'll note that the Nasdaq did dip below the 200-day moving average a couple times during this bear market. Sorry, during this bull market in early the March of 2023, and then late 2023 during that other market bottom in October, again in October 2023. It did dip briefly below the 200-day moving average. It just dipped below now. So that's why I'm saying if there's going to be a turnaround, it needs to probably happen in the next week to 10 days, 2 weeks at most. I think the selling needs to at least slow for then, and if not, bottom altogether in the next week to 10 days.
Yeah. Dow also below its 200-day. Russell, but it's
Russell definitely
been
is.
below its 200-day for all of March and the last like week or so of February. So everything is sort of pointing in that direction. 57.38 is what I'm seeing is the 200-day. So a close below there gives you a daily and weekly close below the 200-day moving average. So not great. Um, yeah, man, it's a
It's
tough
rough out
mark.
there now.
It is. And
But maybe
the
this feeling, this is the absolute reverse of when we, come on here in the last 9 months and everyone's super bullish, and then the
yeah,
market tanks like last July. Maybe we'll be sitting here a week from now and be like, seems like that was the bottom. Sometimes Mondays and Fridays have been inordinately strong in the last year. It's the middle of the week that is sort of the problem. Um, so we'll see if we'll see if a new week can have the same effect. Um, yeah, we'll just
the
see. I think it'll be, I think we may know our answer a week from now.
the one I'm gonna leave. I'm gonna give you a silver lining for one thing. I'm gonna give you a cautionary thing and a silver lining. The cautionary thing, it's not like we're coming off of like a modest market that's done fairly well but hasn't been
Right.
skyrocketing, right? We're coming up from super extremely elevated valuations.
Yeah.
We have talked about the Buffett indicator and talked about Schiller PE and a number of those things on this show multiple times. We are coming off a really highly valued market,
Mhm.
which means that your value buyers are looking at much lower prices. We are seeing distribution from the Magnificent Seven, the names that have been driving the bull market higher for the last 2 years, right? Where big money is selling those, and then it's sort of a question of where they're pushing money next. And I know Jacob Mintz of options, Cabot Options Trader, has written about a couple of times. There's some strength in other sectors that money is rotating places, so it's not a flight to safety. And that's the silver lining. We are seeing an orderly distribution from really high prices. We're not seeing panic selling right now. Um, right. Institutional sellers are not dumping at whatever price they can get. They're trying to work their highly appreciated stocks into the market in a manageable way that translates to a drawdown that is well controlled. So
Right.
this is not 1929 panic selling that we're seeing right now.
No.
We're seeing an orderly distribution, which is a silver lining. That makes it more likely that we just hit some sort of like fair valuation point beyond which people are saying, no, I'm no longer overexposed to Nvidia, right? And that's obviously a risk too, is if the AI thing fails or blows up, or if Microsoft or Amazon come out and say, well, we've been planning on doing 50 billion a year in capex, but due to what they won't come out and say, well, these AI tools suck and they don't work and we're not making any money off of them, which is true. They're not making any money off of them, but they're not going to come out and say that. What they will say is that business conditions have deteriorated in such a way that we can't justify spending $50 billion a year on capex.
Right.
That I think is your risk for another leg lower, but we haven't seen that yet. We're seeing
Right.
and we're seeing people filing for the exits in an orderly fashion. So it's not the end of the world. It's just not great.
Yeah, and when I said on here a couple weeks ago that I thought a 5% or more pullback was coming, part of that was because the valuations were high, as came from said that fresh off of new all-time highs, despite everything that was being thrown at the market between tariffs and not just tariffs, but you know, um, Fed slowdown and interest rate high. I mean, that's definitely part of this. Interest rates clearly going to be held flat for probably through at least the first half of the year, if not longer now. And Also, earnings season, I think, was propping a strong earnings season was propping up the market,
Yeah.
sort of keeping things at equilibrium. And now that's basically over. Nvidia kind of like the last shoe to drop there. So now we don't have a real catalyst right now. So that's part of the problem. Now, will that change in the next week to 10 days? We'll see. I think it's going to be very telling. But let's move on to something more positive because it's been negative, sort of topic so far. What is working in the market right now? There are two things that really stand out. European stocks. People as during U.S. volatility, hedge funds, institutional investors have shifted their money to the European stocks. The Stocks Europe 600 is up 8.5% year to date, and value stocks also up just over 2%. Value outperforming growth, a rare thing for the last decade. Either of those seem more appealing to you, or obviously gold has been, is a traditional safe haven and is close to all-time highs. That's another good place to park money in times of uncertainty like this. But in terms of, there are things that are actually making money, and in Europe, stocks are actually making money in part because rates are either already lower or they are projected to cut more during the upcoming year as a big part of it. Their central banks. I think that's the England, the Bank of England? What is it?
Yeah.
Yeah, and then also the European Central Bank.
Yeah, I like European stocks more. Just looking at the premise is US overvalued, there's uncertainty here. You're looking for undervalued opportunities elsewhere. And right now, looking at like the last 20 years, the only sector of the S&P 500 that's trading at fair value on a 20-year PE basis is energy at a 13.9 PE. Almost everything else, even utilities are overvalued, communication
Mm.
services overvalued, even staples. So like these traditionally sort of safe haven assets have been sort of bid up and buoyed by the market, by the general bullish sentiment over the last 2 years. So even the value stuff in the US on a sector basis, not necessarily an individual company basis, is a little bit overvalued. Um, Europe, I think, was at a 25-year discount, like a 25-year high discount relative to the US. I know Carl Delfeld of Cabot Explorer has written about that
Hmm.
a couple of times. It's been a little while since I've seen those numbers, but maybe a couple of months ago he was saying it was like a 25-year all-time high or 25-year high discount to the relative to the US. I guess the question becomes then is like, all right, well, are big money institutional investors just reallocating to Eurozone stocks because they're undervalued and they feel overexposed in the US? Or is like that the new trade? If that's the new trade, I think that still has a lot of room to run. If it's just repositioning and they're just getting back up to what should be sort of their historical allocation, I think it caps the upside a little bit. But yes, if you are looking at US value stocks or international stocks, I like established, like first world countries, established markets, Eurozone especially, at least to get up to a sort of fair valuation. And then from there, we'll see.
Yeah. Yeah. If we've mentioned, and some people we've had on here the last few weeks have mentioned stock pickers market. This is even before this, the
Yeah.
markets are pulled back. If you're looking for places to pick, value stocks, even US value stocks and Europe in particular right now are a good place to shift your money if you're not wanting to get out of the market altogether, which, I don't think you should. Um, that's a good place to sort of shift for now. Um,
European defense stocks have also been pretty big winners. One that after Trump talked about his shipbuilding initiative, the Office of Shipbuilding, I was looking at shipbuilders, and BAE Systems is one that has run up a lot.
mhm.
That was running up prior to the shipbuilding thing, but on speculation that European defense would rise. I know Germany has come out and said that they're going to be raising capital and spending more money on defense in the continent. So that's one area that has been particularly strong. I imagine healthcare, right? Like the whole world is getting hit by this aging population mega trend. Healthcare expenses
Yeah.
are going up everywhere. So European healthcare, European defense are some that I like. European goods, if they're selling into the US a bunch, I probably don't love as much uh, because of the tariff threat thing. But those two sectors are two that are definitely worth watching and seeing if you can find some names in there.
Okay, let's shift to our featured segment in just a minute. Before that, though, we have a special offer today for anyone who's listening or watching us. We'll have a link to click to it on the blurb on our YouTube page. Cabot Top 10 Trader, which is run by Mike Santolo, frequent Street Check guest, is we're offering for half off the normal price, say 50%, $347 for 1 year, and 30-day 100% money back guarantee. If you go to cabotwealth.com/street, cabotwealth.com/street. Again, it's 50% off the normal price, 30-day 100% money back guarantee if you don't like your subscription, but I think you will. Top 10 Trader is 10 of the strongest stocks in the market every week. Mike runs Cabot Growth Investor, which is the growth stock advisory, and right now that's in what, 70 some percent in cash. So, but Top 10 Trader is different. He has 10 stocks every week, and it's 10 stocks in the market, 10 of the stocks in the market that are working well, that have momentum. So there's something new every week, regardless of what's happening in the market. And he spotted some huge winners over the years, including Tesla in December 2011, which is arguably the best stock in the history of Cabot. And you get a new write-up every Monday afternoon, And if you sign up, you get access to a free special report, how to squeeze an extra 50% profit out of every trade. And you get access to Mike's personal email address. Again, that's at cabotwealth.com/street, and we'll have that place to click on that on the YouTube write-up. Um, okay, now let's move to our jump ball segment, something we've done in the past. It's just sort of a fun exercise where we pit two things against one another, and you and I each pick which we think is going to happen. So let's go through these pretty quickly. Spend a lot of time on the doom and gloom, but this
Oh,
let's get
yeah,
some.
you're in my world now. You adopted the darkness, but I was born in it. It's bear
Let's
time.
go. Yeah. Um, okay. S&P 500, 6,500 or lower by
Lower.
year's end. When I
Uh,
wrote this last night, that was 12%, 12.7% higher from where the market is, more than that now, 13, 14% higher. Coming into the year, I would have said easily over. I'm going to stick to the optimistic take. I'm going to say everything seems miserable right now, which is why I think there's a decent chance we could get a bounce back here in the next couple of weeks. And, again, we sat here just 2.5 weeks ago, or sorry, 2 weeks ago, and the market had just hit new all-time highs. S&P was at over 6,100. So, a lot can happen between now and the end of the year, good and bad. I choose to be optimistic and choose to think that, we're in a bull market, that the economy will hold, and that we won't enter a recession, that inflation won't spike enough to cause utter panic. I'm going to say higher than 6,500. It sounds like you're going the other way.
yeah. We had back-to-back 20% plus years in the S&P. We're coming off a period of really high valuation. I've been whinging, I believe is the
Yes.
Britishism for
Yeah.
it, about the market being overvalued for a while. I don't think we're well positioned. Coming into the year, people were high spirits, pretty exuberant. Um, Valuations didn't matter, fundamentals didn't matter, as long as we were on the descent to the soft landing. Um, and in that environment, if people are still spending and people are still supporting the economy, yeah, I could have seen us hitting 7,000, right? Like that would have been a 15% gain on the year. That was in the cards potentially, given what we've seen in the last 2 months plus, um, and how far we potentially have to fall. I like even if we just hit correction and drop to 5,200, right? That's or no, I guess that would be if we drop to 5,400. So that's
Yeah.
10%. We drop to 5,400. For us to get then to 6,500, we would need more than a 20% run up from those lows. I don't see what the catalyst is that pushes us there. I even if we end up turning this around and we close like modestly higher on the year, I think that would be a win at this point. So I think if we close in like 62, 63, that's a winning year, right? It's a profitable year. It probably requires that the Fed starts easing a little bit more. Um, Money printers have to turn back on, that kind of stuff.
Mhm.
But given the state of the market today and the way things are looking and certainly feeling, um, we've talked about like the K-shaped recovery from the pandemic, and that bottom half of the K is feeling it, and they've been feeling it for a while, and now the upper half of the K is starting to get sensitive to it. So I just don't think we can get over 6,500.
Yeah, we'll see. I mean, the July, August pullback was from 56.67 in the S&P to 51.86 on August 5th. And by year's end, they were up in the 5,800s.
Yeah,
So, things can bounce back quickly. I would point to the very strong earnings growth from this recently completed quarter. And I would point to investor sentiment being so negative that, uh, you know, I'm going to take the contrarian stance that I
Yeah.
think we're going to get there, and we could use a little optimism right now.
Well, we were talking about Mike a little bit. The cat, I don't think he ever hit this level of cash in the August correction.
Yeah,
Um, I think it's going to take time for like new leaders to, or I know he has written that it's going to take time for new leaders to emerge. I would agree with him with that sentiment. Um, Before it was like, yeah, we were overvalued and we took a haircut, but the narrative was the same. The clear leaders were still the same, and I don't think this is going to be quite as smooth sailing as that correction, but we'll see.
yeah.
Maybe we close today at like 5,800 on the S&P and everybody's like, "Oh, woo, stick saved by the 200-day moving average. We're back in business, and we rip higher." I don't know. I don't see it.
All right, let's move to the next one. Bitcoin versus gold, which will be higher by the end of the year. I think I know where you're going with this after your last answer.
Gold.
Yeah, I'm going gold too, even though I think that the market will get to 6,500 by year's end. I don't think it's not going to feel like the last couple years. I don't think it's going to feel, you know, like, you know, go growth, AI, splurge market like it has at times the last couple of years. While Bitcoin could be higher by year's end, I still would trust gold more. Gold, even at 2,900 an ounce, has just been on steady rise amid all the uncertainty and high inflation, high interest rates the last couple of years. Seeing that interest rates will still likely, or at least at the very least, won't be cut by too much by year's end. I would have faith in gold. It's up 35%, 36% in the last year, 75% in the last 5 years. Um, Bitcoin, who knows? It's a bull market play, and while I think the bull market will remain intact, I don't think that it'll be the type of environment that sends Bitcoin prices to through the roof again. So
So,
I'll go gold.
yeah, I'm obviously gold as well. Here's one thing that I think, even if you're maybe a little bit bullish on Bitcoin, probably will throw some cold water on it. Um, right, Bitcoin is an extension of willingness to take risk in the market. Small caps sort of meet those same criteria. Small
Mhm.
caps down 16.7% from their November 2024 highs. So small caps are closer to being in a bear market than they are to being in a correction. It doesn't bode well for other highly risk sensitive assets or plays like Bitcoin.
Well, that rolls
Um,
well into my next one. Small caps versus
oh,
large caps by year's end.
by year's end, I my I don't know. This is maybe contrarian. I think maybe small caps bottom first.
I agree.
Right? Like if small caps drop another 15%, they lose 30% from November highs. They bottom and rebound and stuff starts looking maybe a little bit more positive, whereas large caps just have a little bit further to fall.
Yep.
Um, the problem is it's contradictory. If I say no, we're in a risk off environment, but I like small caps to outperform, um, I think they can maybe do the gymnastics to ultimately close a little bit higher to perform better from here until the end of the year. Um, no, no, I'm gonna go large caps.
Oh, you're going large
I
caps. All right.
talked well,
I got to mark these down.
I talked myself out of it because of the last 2 years, right? We saw large caps grossly outperforming, but small caps just never caught a bid.
Mhm.
So even if we get a recovery, even if small caps bottom first, that's not a guarantee that they bottom and then bounce and start moving higher, right?
Yeah.
You need the large caps to bottom and stabilize, and then they start going higher, and then small caps start getting dragged higher, and then they outperform or catch up. So I
Yeah.
go large cap.
I'll go small just because it's not just the last few months small caps have been underperforming. It's been underperforming for years. It's like close to 5 years now. that they've underperformed, and they tend to outperform. As Tyler said on here, 3 out of every 5 years they tend to outperform. Um, I think so that's part of it. And as you mentioned, they are fallen further, have fallen faster. They started falling before the large cap indexes in the last few weeks. Um, Similar to how the Nasdaq, or sorry, not that, growth stocks in general led the bear market down in end of like they started falling with a few months to spare in 2021, whereas the broad market didn't start to fall and eventually enter bear market territory until early 2022. But then growth stocks led the charge back up, led by the Mag 7 and some AI stocks. But with that same premise, I think small caps will be first to bounce back. And I just said, I don't think the bull market is going to end. So I think, um, small caps will sort of, if not lead the bounce back, I think they could be more appealing to people who are looking for value.
Yeah, I think that's a close call.
Yeah.
Um, and like who knows what the next 10 months or 9 months, 9.5 months at this point are going to bring. Um, Maybe
Yeah.
we get some other sort of like out of nowhere AI thing that where it's like, oh, these small companies are now exploding in value because of X, Y, or Z. I think you can make, I definitely think you can make a case for it. Um,
Yeah.
the
Yeah.
valuation thing, they've just, although we're seeing it with Europe right now, right? Spent 25 years, trading at a significant discount, and people just see it and they say, like, hey, stability, growth prospects, good place to be.
Yeah.
There's probably a valuation case to be made for small caps as well. So I think you can go either way on this one.
And again, you're doing a good job of doing my segues for me. You just mentioned European stocks. Next one is European stocks versus U.S. stocks. Rest of the year.
European, um,
So I
cheap.
just said U.S. 6,500. Man, so that would be 13, 14% from here. European already up 8%, 8.5% year to date. Why don't you elaborate on yours before I give my answer?
They're cheap. They're
Yeah.
cheap, and they like continental Europe is 700 million people, right? Like if the U.S. adding imports to European exports or adding tariffs to European exports, it's not like it shuts out the entire market. There's still a huge population that can buy there. Um, I wouldn't be stunned if Eurozone stocks were up 30% for the year. Like you said, they're up 9% already. The US has attracted something like 60 or 70% of all the investable capital on the planet. If people are leaving the US, they are going to go somewhere. China is tough. Emerging market is tough to get exposure to. Europe is like the obvious choice there. So you don't even need people blanket selling in US stocks and like panicking over the US
Right.
economy. All you need is, 10% of overinvestment in the US stocks being moved to Europe, and you've got a lot of opportunity for growth there. I could see European stocks being up big this year.
I agree. I think Europe, I'll go Europe too. I agree. We could be up 20, 30% this year, European stocks, where, by that definition, it would still outpace even my, rose-colored view of the S&P topping 6,500. Valuation, I think, is the biggest thing. Right now it's both a valuation and maybe flight to safety thing. And even if the flight to safety thing doesn't is less necessary the back half of the year, I still think, valuations are appealing and sort of a happy medium between US volatility and, people not wanting to invest in China or other emerging markets type of thing. So,
Here's the other thing. If you look back over like the last 20 years, the amount of federal deficit spending in the US has directly translated like dollar for dollar to equity market gains. I don't know the study author or who published it, and I apologize for that, but our deficit spending has been like 88%, super highly correlated with stock market gains. If
yeah,
the Eurozone is going to start deficit spending, which it seems like they are, then, and if it follows that same kind of pathway, then that also translates to gains because it takes public sector debt and turns it into private sector profits and equity.
Yeah. And more rate cuts too, I think is a big part of the reason to be bullish on European stocks. That like I said, rates are already lower there than they are here, at least the European Central Bank, and they're at least forecast to cut even faster this year, which dovetails well into my next one. Fed rate cuts over under 1.5 cuts this year.
Cuts,
Yeah.
I'll stick with I think I was last time we talked about this, what, like a month and a half ago.
Yeah.
I think I was under, and I'm sticking with under. Um, I mean, like barring the problem is if they're cutting rates now, it's because the job market is super weak. It's because the economy is super weak. So hopefully no cuts. Hopefully they just hold and
Mhm.
inflation maybe moderates a little bit. We get past the tariff thing. Um, but I'm hoping they don't have to cut. If they have to cut, it's a rescue cut and it's not a confidence cut.
I've been saying I think I've thought two just to go along with their own dot plot. Two cuts by year's end, but all the tariff stuff the last few weeks throwing maybe a wrench into that. I think I'm gonna go one now. I'll go under 1.5 with you, but there's a chance that it could be more based on the not so great scenario that you're talking about. That um, that to do it out of necessity to you know sort of reinvigorate um, growth and avoid sort of the stagflation scenario you outlined earlier.
Yeah, the one thing I am curious about is like what kind of lag time they'd be working with.
Hmm.
Presumably, I think a lot of the data operates at like a 6 month lag before you start to expect to see the impacts of fiscal policy, which would mean it's probably not until Q4 or late
Yeah.
Q3 that you see the effects of some of the economic policies that have been implemented showing up in the numbers. So, maybe that ends up maybe people are on the fence about cuts in the end of the year and then they just end up getting pushed to Q4 or into Q1 of 2026 based on timing. So I could see that. I could see no cuts even with the tough economy thing. I think it would take a lot of negativity and a lot of pain for us to
Yeah.
get to the point where we're doing the saving the economy cuts in this
Yeah.
calendar year.
Yeah,
We'll see
I'll,
though.
I'll put the difference. You say zero cuts, I'll say one. I think the one will be the back half of the year for better reasons than what you're, saying they could cut for.
Yeah.
That aligns with my market being or S&P hitting 6,500 by the end of the year. Okay, one last non-investing one. We usually like to sprinkle this in at the end just for fun. Severance or White Lotus. These are the two pseudo mono. There's not a real monoculture in terms of viewing habits these days, but pseudo as close as a monocultural shows that you can get right now. Severance, which is the Ben Stiller directed and run show about. It's on Apple TV Plus about. Uh, Man, it's sci-fi. It's about if you sever your work brain or sever your brain to the working half and they call the outie half, your non-work brain, and the two are not aware of each other. Um, that's the simplified version of it. Very entertaining show. Or White Lotus, which is about rich people on a beach. The third season of it. It's the name of a resort. There's a White Lotus that's in Thailand this year. Either, neither, or both. Which you prefer?
I've seen a little bit of Severance. A lot of TV shows I don't end up watching, but I end up being like next to my wife while she is
Right.
watching it and will catch some. Severance has been sort of like that, where I've watched maybe 45 minutes of this season. Seems interesting.
Yeah.
Love Zach Cherry. He's a great actor. It's
Which one is
curly
he?
hair, curly hair, beard. The guy whose inside person has been seeing his wife, I think.
Oh yeah, 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 yeah,
Love that guy.
yeah.
White Lotus, I saw a little bit of the first episode and I thought it was atrocious. I don't like the idea of watching rich sociopaths abuse staff members at resorts. I don't get what the
Yes. Yeah.
appeal to that is. But
Yeah.
I will make one note, which is there's a British actress in that show who did a limited series called Toxic Town that I just watched with my wife the other day. I thought it was great. But yeah, if I have to watch one of those, it's Severance. But I haven't really seen either. What about
I
you?
do watch both. Yeah, I'd say White Lotus is more of a hate watching situation. Severance, I'm way more into. Severance is really fascinating. You got to really pay attention. The second season of that, you got to really pay attention and probably and definitely start from the beginning if you haven't watched it and want to catch up. Again, that's on Apple TV Plus. White Lotus, I believe, is on Max. But yeah, I would recommend. I'm team Severance on that one. If sci-fi, people can your mileage may vary on the tolerance for sci-fi things, but this is sort of grounded in a very human story. So I think if you're looking for something, that would be my recommendation. Okay, we've gone on long enough today. Like I said, there was lots to talk about. Hopefully, injected enough positivity in there, and hopefully our negativity is an indicator in itself. Just like the inverse of when our positivity on a bull market has been a reverse indicator before. Hopefully, a week from now, I'll be like, wow, we were overly negative for no reason last week.
Yeah,
Let's hope.
I already catastrophize stuff. Like I skew negative bias, so when I get reinforcement from the market, it just makes me think I'm more right. I could be wrong as I am frequently. So hopefully I am. It would be
Yeah.
great for my 401k.
Yes. It'd be great for all of us, I think. If you have any, thoughts or questions for us about this episode or any episode, street check at cabotwealth.com. Email us. As always, like and subscribe, whether you're on YouTube or listening to wherever you get your podcasts. And we will see you again next week.